It's an interesting time, I think, right now for private equity in middle market transactions. And if you look historically over the past several years, especially over the kind of booming years that we had a couple of years ago, private equity was really able to dominate the landscape in a number of ways. Often I'll take a deal to both a private equity buyer and a strategic buyer, and the private equity buyer will get the teaser and call me and say, I'll be on a plane tomorrow, I want to meet the company. And the strategic buyer would say something like, well, this is pretty interesting. The guy we have who looks at this sector is on vacation for a couple of weeks, and then when he gets back, we'll have a meeting in a couple of weeks, and then maybe we'll get back to you in a month or two and tell you if we're interested in taking a look. And it wasn't a stall, that's just how a lot of the big strategics move. If you're talking to, a Microsoft, a Cisco, an Apple, that's just their pace of business. Whereas private equity could literally get on a plane the next day. And so they're known as moving really, really quickly. In addition to that, when debt was literally almost free, they could do a leveraged transaction, and they had a real advantage in terms of pricing as well. So we always considered private equity to be kind of the high price player, that you would get a better deal from a private equity firm and that they would also move faster. That has kind of come to an end as we've seen the highest interest rate in, I think, 22 years currently, and potentially going higher in the United States right now. Private equity no longer has access to free capital for leverage, and they've found themselves kind of on equal footing with strategics. Actually, maybe even a disadvantage to a strategic, because a strategic always intends to pay with cash and stock, whereas private equity has to now redo their ROI calculation and include a much higher cost of capital.